In March of 2007, I was sitting in our offices at Oaktree, looking at a deal that would have generated spectacular returns. We're talking about projected IRRs north of 25%. The structure was elegant. The collateral looked solid. Every analyst on our team was enthusiastic. I was about 61 years old at the time, and I'd been investing in credit markets for over 3 decades. This was exactly the kind of opportunity that had built our reputation. But something made me pause. Not the analysis was fine. Not the structure was sophisticated. It was a principle I'd learned 20 years earlier from watching what happened to people in their 60s during the 1987 crash. A principle about risk that had nothing to do with volatility or beta, or any of the metrics in our models. That pause, that decision not to proceed despite the compelling numbers, saved our investors hundreds of millions of dollars over the next 18 months. More importantly, it preserved capital that we deployed in late 2008 and 2009 at prices that seemed impossible. What stopped me wasn't brilliance. It was understanding something about risk that most people, especially people over 60, get backwards. Let me tell you what it was, because if you're in your 60s or beyond, this principle matters more to you than any other investment insight you'll ever hear. Before I continue, I need to know something. Drop your age in the comments and tell me honestly. What's your biggest fear about your money at this stage of life? Running out? A market crash? Healthcare costs? I want to know what keeps you up at night, because the principle I'm about to share addresses the real risk, not the one everyone talks about. And if you're serious about protecting what you've spent a lifetime building, subscribe now. This channel isn't about beating the market or finding the next hot stock. It's about second-level thinking, the kind of analysis that's protected wealth through 8 market cycles and counting. The kind that separates people who stay comfortable in retirement from those who don't. Now, here's what I'm going to show you. The risk secret that conventional financial planning completely misses. Why everything you've been told about age-appropriate investing is dangerously incomplete. And the specific framework that's kept Oaktree's investors safe while still generating returns. But the most important insight comes at the end, so you need to stay with me through all of it. Let me start with what everyone gets wrong about risk after 60. They think risk is about volatility. They've been taught that as you age, you should reduce stock exposure and increase bond exposure because stocks are risky and bonds are safe. Every financial advisor has shown them the pie charts. Every retirement planning book has the same guidance. Reduce equity exposure by 1 percentage point per year after 60, or follow the rule of 110 minus your age in stocks. It seems logical, it feels prudent, but it's dangerously incomplete, and here's why. It confuses price volatility with actual risk. Price volatility is how much your account balance fluctuates. Actual risk is the permanent loss of capital or purchasing power. They're not the same thing, not even close. And the difference between understanding this distinction and not understanding it is the difference between a secure retirement and a catastrophic one. I learned this watching what happened in 1987. I was in my early 40s then, working in the high-yield bond market. I watched retirees, people in their 60s and 70s, react to the October crash. The ones who understood risk stayed calm. The ones who confused volatility with risk panicked and sold. 20 years later, the difference in outcomes was staggering. The people who panicked had spent 2 decades in money market funds and CDS, watching inflation slowly destroy their purchasing power. The people who understood risk had stayed appropriately invested and maintained their standard of living. This isn't about being aggressive in retirement. It's about being correct about what risk actually means when you're over 60. And being correct about risk is more valuable than any investment strategy, any asset allocation model, any financial product anyone will ever sell you. The principle that stopped me from doing that deal in 2007 was this. When you're over 60, the biggest risk isn't losing money in a market downturn. The biggest risk is not having enough money when you need it. Those sound similar, but they're completely different. Losing money in a market downturn is temporary if you don't lock in the losses. Not having enough money when you need it is permanent. The first is a price problem. The second is a resource problem. Most financial advice focuses entirely on the first and ignores the second. That's backwards. Let me show you why this matters so much right now, and then I'll give you the complete framework for thinking about risk correctly at your age. The foundation of everything I'm about to tell you rests on one critical insight. Risk changes as you age, but not in the way conventional wisdom suggests. Most people think risk increases with age because you have less time to recover from losses. That's first-level thinking. Second-level thinking recognizes that your risk profile changes because your needs change, your flexibility changes, and your time horizon for different pools of money changes. You're not a single investor with a single time horizon. You're multiple investors with multiple time horizons, all living in the same body. The money you need next month has a 1-month time horizon. The money you won't need for 15 years has a 15-year time horizon. The money you're leaving to your children has a 30-year time horizon. Treating all of it the same way is the first mistake people make. Understanding this is the foundation. Without this, nothing else I'm about to tell you will make sense. So let me break down exactly what risk means when you're over 60 and it's not what you think. First, there's sequence of returns risk. This is the danger that a major market decline happens early in your retirement, forcing you to sell assets at depressed prices to fund living expenses. This is real. This is dangerous. This destroyed people in 2008 who retired in 2007. They had to sell stocks at 50% discounts to pay for groceries and property taxes. Those losses were permanent because they couldn't wait for recovery. But here's what most people miss. Sequence of returns risk is a liquidity problem, not an asset allocation problem. The solution isn't to own fewer stocks. The solution is to own enough liquid, stable assets to cover 5 to 7 years of expenses so you never have to sell stocks in a downturn. This is completely different from the conventional advice. Conventional advice says reduce stock exposure as you age. Second-level thinking says maintain appropriate stock exposure but increase your liquidity cushion. The difference is everything. Second, there's inflation risk. This is the danger that your purchasing power erodes over time, leaving you unable to maintain your standard of living. If you're 65 today and you live to 90, you need your money to last 25 years. At 3% inflation, prices will double over that period. The $4,000 monthly income that feels comfortable today will feel like $2,000 in 25 years. Most retirees dramatically underestimate this risk because inflation feels abstract while market volatility feels concrete. When your portfolio drops 20%, you see it immediately. When inflation erodes 3% of your purchasing power annually, you barely notice until years later when you suddenly can't afford things you used to buy easily. This is insidious, and the traditional solution, moving heavily into bonds and cash, makes it worse, not better. Because bonds and cash don't protect against inflation. They guarantee you'll lose to it. Third, there's longevity risk. This is the danger that you outlive your money. Life expectancy at 65 is roughly 20 years for men, 22 for women. But those are averages. Half of people live longer. If you're married, there's a 50% chance one of you will live past 92. A 25% chance one of you will live past 97. You might need your money to last 35 years. Think about that. 35 years is the same span from 1990 to today. Imagine trying to fund your entire life from 1990 forward with a portfolio you built in 1990, never adding another dollar. That's what you're asking your retirement portfolio to do. And the conventional solution, reducing growth assets as you age, makes this harder, not easier. Fourth, there's healthcare risk. This is the danger of catastrophic medical expenses destroying your financial security. The average couple retiring today will spend $315,000 on healthcare over their retirement, according to Fidelity's estimates. But that's average. If you develop a chronic condition, need long-term care, or face a major medical event, costs can be multiples of that. Medicare covers a lot, but not everything. The gaps can be devastating. And here's what makes this particularly dangerous. Healthcare costs inflate faster than general inflation. They've averaged 5 to 6% annual increases for decades. Your healthcare expenses will likely triple over a 25-year retirement. Most people don't plan for this. They assume Medicare will cover them. It won't, not fully. Now here's the second-level insight that connects all of this. The conventional approach to risk in retirement, reducing stock exposure, increasing bond and cash holdings, focusing on stability, protects you from the least dangerous risk while exposing you to the most dangerous ones. It protects you from short-term volatility while exposing you to inflation risk, longevity risk, and insufficient resources. This is backwards, completely backwards, and it's destroying retirement security for millions of people who think they're being prudent. Let me show you this principle in action. In 2007, I met with a couple, I'll call them Robert and Linda, who were both 68. They'd retired 3 years earlier with $800,000. Their advisor had moved them to a 30% stock, 70% bond allocation because they were in their 60s. Conservative, prudent, safe. By 2009, their portfolio was worth $680,000. The stock portion had dropped, but the bonds had held up. They felt vindicated in their conservative approach. But here's what happened over the next 15 years. Their portfolio generated roughly 4% annually. Inflation averaged 2.5%. They withdrew 5% annually to live on. By 2024, their portfolio was worth $520,000 in nominal terms, maybe $380,000 in real purchasing power. They were 75 and 83. They were running out of money, not because of 2008, because they'd spent 15 years earning 4%, losing 2.5% to inflation, and withdrawing 5%. The math doesn't work. Meanwhile, a different couple I knew, similar age, similar portfolio size in 2007, maintained a 60% stock, 40% bond allocation, but kept 3 years of expenses in cash. They took the same hit in 2008 to 2009. Their stocks got crushed, but they didn't sell. They lived off their cash cushion and let their stocks recover. By 2024, their portfolio was worth $1.4 million. Same starting point, radically different outcome. The difference wasn't risk tolerance, it was understanding what risk actually meant at their age. At Oaktree, we think about this constantly for our investors. When we raised $11 billion in 2008 for distressed opportunities, a significant portion came from endowments and foundations, institutional investors with truly long-time horizons. But we also had individual investors in their 60s and 70s who participated. Not with all their money, not even with most of their money, but with the portion of their portfolio they didn't need for 10 to 15 years. They understood that they were multiple investors with multiple time horizons. The money they needed in 2009 and 2010 was in cash and short-term bonds. The money they didn't need until 2020 could be invested for growth. This isn't aggressive, this is correct. And the returns from those 2008 investments, we're talking about multiples of capital in some cases, made an enormous difference to their long-term security. So what do you actually do with this? Let me give you the specific framework. Before you make any investment decision, ask yourself, when do I need this specific dollar? Not when do I need money in general. When do I need this specific dollar? If the answer is within 5 years, it should be in cash, short-term bonds, or other highly liquid stable assets, not because you're being conservative, because you're being correct about time horizon. If the answer is 5 to 15 years, it can be in a balanced mix of stocks and bonds. If the answer is more than 15 years, money you're leaving to heirs, money you won't touch for decades, it should be heavily weighted towards stocks, because over 15 plus years, stocks have never failed to outpace inflation, and bonds frequently have. This isn't about your age, it's about the age of each dollar. A 65-year-old with money they won't need for 20 years should invest that money like a 45-year-old. Because that money is 45 years old in terms of time horizon. Now track these metrics quarterly. Your liquidity cushion, how many years of expenses you can cover without selling stocks, your real return, your return after inflation and withdrawals, your healthcare reserve, how much you have specifically set aside for medical expenses, and your longevity runway, how many years your current portfolio will last at current withdrawal rates and realistic return assumptions. These aren't complicated. You can calculate them on a spreadsheet in an hour, but most people never do. They look at their total account balance and assume they're fine. Then they're not fine, and it's too late to fix it. The harsh reality is this: most people over 60 are taking the wrong risks while avoiding the right ones. They're protecting themselves from volatility while exposing themselves to destitution. They're being conservative in ways that guarantee failure. And they're doing it because they've confused price fluctuations with actual danger. You now understand what took me decades to learn. You know that risk isn't volatility. You know that you're multiple investors with multiple time horizons. You know that the conventional age-based allocation models are dangerously incomplete. The question is, will you act on it? Because here's what I've learned after 50 years. Knowing what to do and actually doing it are completely different things. Most people will read this, nod along, and change nothing. They'll keep following the conventional advice. They'll keep treating all their money as if it has the same time horizon. They'll keep confusing safety with prudence. Don't be most people. Before you go to bed tonight, calculate your liquidity cushion. How many years of expenses can you cover with cash and short-term bonds without touching stocks? Write down the number. If it's less than 5 years, that's your first priority. Not rebalancing your portfolio, not finding better returns. Building that cushion. because that cushion is what allows you to invest the rest of your money correctly. That cushion is what lets you survive the next 2008 without panic selling. That cushion is the foundation of everything. And drop a comment right now with your age and your biggest financial fear at this stage. I want to know what's actually keeping you up at night. Because the principles I've shared today address the real risks, not the imaginary ones. This isn't about market timing or stock picking or finding some magic investment. It's about understanding risk correctly. It's about thinking in second-level terms. It's about recognizing that being over 60 doesn't mean being timid. It means being precise about which risks matter and which don't. Subscribe if you want more of this kind of thinking, not hot tips, not get-rich schemes, just clear, second-level analysis of what actually matters for protecting and growing wealth at every age. Because I've spent 5 decades learning how to think about risk correctly. You can learn it much faster if you pay attention. Risk isn't what most people think it is, especially after 60. The riskiest thing you can do is follow conventional wisdom that protects you from volatility while exposing you to poverty. That's what 50 years of investing teaches you. That's what surviving 8 market cycles shows you. That's what building Oaktree into one of the world's largest alternative investment managers proves. Protecting your nest egg isn't about avoiding stocks. It's about understanding which money needs protection and which money needs growth. I can't make these decisions for you. I can only show you how to think about them correctly. The rest is up to you.